Nick, good to see you. I'm really looking forward to today's conversation, which is why DIY investors earn less. According to Vanguard's Advisors Alpha study, a good financial advisor can add about 3% in net returns per year. Per year. That bears repeating. What do you think is behind that performance gap?
Well, so you said 3%. I kind of thought about that. I'm thinking those small little things, those small little changes, the small little moves make a big difference, right?
Right.
I'm a big golf fan. I remember back in the day when Tiger Woods was really in his prime, and his stroke average was really only like, it was like less than 1% better than everybody else.
Hmm.
But yet he was winning every tournament because a tournament's 4 days. So if he was just one stroke better every day, that's 4 strokes. Well, if you win a golf tournament at the pro level by 4 strokes, they call that domination.
Mm.
And so a little bit adds up over time. Small moves can make a difference. 1% here, 1% there, it all adds up. So that Vanguard study came out and it said, like you were saying, that a person who does it, DIY, do it yourself, and versus somebody who works with a advisor, that person who works with an advisor has, I think what you said, 3% per year better.
Per year, yeah.
And so when I dove into that study and started looking at it a little bit more, the DIY investor, a lot of them are trying to day trade because you turn on CNBC, you turn on Fox Business News, you have your ticker on your phone, you can download apps and all sorts of things to trade, and people are starting to do day trading. I mean, everybody's got a Robinhood account. I mean, I have little old ladies that a couple years ago had Robinhood accounts, and they were plugging money in there because their grandson said, "Hey, put money into a Robinhood account. Oh, you can do this yourself, mom." Or grandma, you can do this yourself. And now when they're coming back in, a couple years later, I'm like, so what's the value of that Robinhood account? They won't even mention it now. It's like, what's wrong? I kind of lost it. I kind of blew up that account. And it's like, well, what caused that to happen? What you find out is that they got emotionally entangled. They weren't following the math. They were following their emotions.
Mm-hmm.
And so that's what this Vanguard study, I think, is right on, because that's what it's talking about, is the emotion is controlling people's decisions.
Well,
What they
and
hear.
tax planning, rebalancing, asset allocation.
You got all that stuff too. So
Yeah.
it's definitely more than just the mutual fund that you're
Right.
invested in, right? If you're investing the wrong way and Uncle Sam comes in and takes 20% of it away in taxes, well, that wasn't a really good thing.
Right.
So if you do proper tax planning, and an advisor typically helps you, should help you with that, then
Mm-hmm.
you can actually make money by not paying out money to Uncle Sam.
Right.
And if you have the right asset allocation, when you have a market downturn like we've seen fluctuations, we've seen volatility kick into the marketplace. When those things happen, you don't go down as much.
Mm-hmm.
And so there's all these different things: taxes, asset allocation, rebalancing. This is huge. I mean, people will start investing in their 401ks when they're in their 20s. And a lot of times they'll come to us when they're in their 60s. And they have the same allocation at 60 years old than they did when they were 20. They never rebalanced. I mean, I have to pump up a tire every now and again because it doesn't always stay perfect. It changes. I got to change. And so the same thing with this. You got to be able to tweak it, whatever you want to say, to adjust it as time goes on. And that's where this study comes in as to why this is happening. And it's because of these things: taxes, rebalancing,
Right.
that whole slew of stuff that typically a DIY person doesn't do,
Right.
because they're only looking at the investment side
Right.
of things. What am I buying? What am I selling?
And I'm glad you also brought up, though, some of the emotional investing, because I do want to throw another study at you. According to DALBAR, which is a very famous
Yeah.
industry-wide study and comes out every year. I know you know it well, but for those watching who don't, DIY investors often underperform the market as well because we are human and we are driven by emotion.
Well, and it's like a horror movie. It's just sometimes the bottom part looks like a horror movie. And the scene in those horror movies, when I was growing up as a kid, I was like, why did they do this? The scene where the character hears a noise in the basement, and instead of leaving and getting out of the house, they go down to the basement. It's like, hold on, that doesn't make any sense.
Because it's a movie, Nick.
I know, but still, to me, it's not logical. It's like, why would you do that? Get out of the house. Don't stay in the house. Move, go away, get in a car, I guess that would be the end of the movie. Maybe
Right.
that's why they don't do it. But that's why DIY investors, that's what they almost do when the market drops, is they make the worst possible moves and decisions at the worst possible time because of investing. So when the market's down, they freeze. And when they hear how good the market is at the top, that's when they buy. But usually that's that euphoric stage. By the time they've heard it, it's already done. So a lot of DIY investors are getting their tips from talking heads on TV and things like that, who are talking about things after the thrill is we're through the thrill stage and we're euphoric about it, and then we buy it, and then all of a sudden it starts going down, and we wonder why.
Right.
And I think that's what this study is really saying. That DALBAR study came out, is it really said that the average do-it-yourself person is, I think, only averaging 3% average returns on their money, and that's not even keeping up with inflation.
Right. Well, it's like Wayne Gretzky said, right? You got to skate to where the puck is going to be, not where the skate is. It's not where the
Amen.
puck is.
And what would he know? I mean, that he's amazing.
Yeah. All right. Many DIY investors believe they can save money by avoiding advisory fees. How do you help clients understand the value you provide?
Well, I heard it said once that you can step over dollars to pick up dimes. And sometimes, everything is going to have a cost. There is no way, shape, or form, even your 401k. I have one here at the company. I looked at that. They said, oh, you only have a very small fee for us managing it. But then when I actually looked at the internal fees inside the mutual funds, I mean, my fee is like several percent. And it was like, wow, that's not good. But there's the fees that you see and the fees that you don't see. On our end is, we're always very transparent with what those costs. And sometimes there's fee-based plans, and sometimes there's non-fee-based strategies that aren't fee-based. And sometimes you blend those two together and you get a better result. But the thing is, you can save yourself a buck, but then miss things like, I saved myself a buck, but now what do I do because the market's going down? Or, how do I lower my taxes? That might be something that you're missing, or maybe maximizing your Social Security. These are things that a good advisor should be doing, is helping you maximize your Social Security so you're getting more out of the system, making sure you don't run out of money by running financial simulations that can show you that that's not going to happen. Mm-hmm. They might be able to help you with healthcare costs, Medicare, long-term care, that type of stuff. Maybe passing on your money as easily and effortlessly as possible without probate getting involved, to your next generation. Maybe it's charitable giving. So it's more than the stock that you're buying. It's more than the mutual fund that you're buying. In fact, how I look at this is a really good advisor is going to look at investment planning, income planning, tax planning, healthcare planning, and estate planning, those 5 things. The problem that I see a lot, Aaron, is people are paying 100% of the fee for people to just do money management. And that's only 20% of the work. So they're really paying 100% of the fee for 20% of the plan. Mm-hmm. And that's not a good deal.
Right. For someone then who's thinking about hiring an advisor, what's the best way to start that conversation to determine if they should? And what should they expect in that first conversation?
Well, number one, it shouldn't be a sales pitch. Bottom line, if you're going in expecting that somebody's going to open up a pie chart thing and say, here, you need to invest in this. Well, that's what those cubicles are in banks. That's what they do. They're not really involved in the relationship. They're involved in turning over, bringing in assets. And I tell people, when you're hiring somebody, you're not hiring an advisor, you're hiring a retirement architect, somebody who's going to get in there and look at your financial life and design a plan across all sorts of different areas, looking for all the things that could hurt you and having a plan to protect against it, looking at what happens in the stock market and making sure that a stock market crash doesn't uproot what it took you so many years to build. So you almost have to look at it like a relationship with a retirement planner or a financial advisor is really 20 to 30 years. So you don't want to look at somebody for a transaction. You want to look at, how is this person going to help me, and how's this person going to have my back for 20 to 30 years? This person's going to ask you things like, where are you now? What have you done so far? What are the gaps that you have? And they should act like a teacher. They should have the heart of a teacher, telling you, let me help explain this to you so you understand. Mm-hmm. And it should be somebody who can do the full service type thing. I mean, I hate going to places and they only get me part of the way there. And it's like they leave me at the smoking gun. I like a plan where everything can be done in one place. And I can just say, here, I'm going to look at my finances, create a plan, and have somebody help me execute it. Mm-hmm. It's the execution that matters.
And Nick, what are those 4 letters after your name?
MRFC. So that stands for Master Registered Financial Consultant. Mm-hmm. So it's the International Association of Registered Financial Consultants. It's an international organization. A lot of people know CFP, Certified Financial Planner. Certified Financial Planner is predominantly mostly United States, but the IARFC, the International Association of Registered Financial Consultants, is global. And so they have a couple different designations, but their main one is the Master Registered Financial Consultant, that you have to be able to qualify for, take a test for, to get that designation. I think there's only maybe 100 or so of us worldwide. But it definitely, I sat on the board of the IARFC for 9 years. I don't know if you knew that. Something you didn't. So I was the youngest vice chairman of the International Association of Registered Financial Consultants. And so an organization I deeply believe in, with a great mission, helping financial advisors and supporting them and helping the public really, by making people better financial advisors. So I think it's a missing thing, because, the other day I was talking to somebody who said they went to college and didn't learn one thing about finance. And I'm thinking, that's a shame.
That's a topic for another conversation, Nick.
But it sucks.
It is, yeah, absolutely. I wish my kids were learning about it in elementary school.
Is that
right
a bad
now.
word that I just said? Sucks. I don't know if that's a bad word.
I don't think we allow it with my kids, so maybe.
Oh, well, so when this gets uploaded on YouTube, there's a little box at the bottom that says, is this child friendly? And I guess the team will have to uncheck that it's not child friendly anymore. Sorry, guys.
We're growing up, Nick. All right. Well, hey, Nick, if somebody is looking for a second opinion on their plan or their portfolio, or they would like to talk to you about more holistic planning, tax planning, rebalancing, what's the best way to reach you?
So you can call us at 844 Group 10. The best first step is to find out, we do a 15-minute strategy session where we can find out what's going on, what gaps that you have. And it's really super simple, is to find out what's going on. And then if it feels right and it feels comfortable, then maybe there's additional planning that needs to happen out of that. But the very first thing that should be done is just finding out, are you okay? Are you not okay? And what can be done about it?
Yeah, right. And maybe you'll find out you are okay. So that's also good.
It'd be great.
Nick, thank you so much for your time today.
Great being with you.